Okay, our next reading is understanding the balance sheet. First things, we've been asked to describe the elements of a balance sheet, in particular assets, liabilities and equity. So here we have a classic balance sheet here. This balance sheet is actually known as account format because it has the assets on the left and the liabilities and equity on the right. So you can see we've got current assets and long-lived assets, i.e. we're distinguishing between the assets that are going to be either cash or convertible into cash within the next operating cycle, and long-lived assets, the infrastructure in which the company is operating from. We've then got our liabilities and equity. Liabilities being amounts that are due within the next operating cycle. Long-term liabilities, amounts falling due after that. And then remember, the definition of a liability is an amount owed to a third party. Then we've got our residual, our owner's equity. Contributed capital would comprise of two elements: the common stock issued at par and any additional paid in capital. And then we've got our retained earnings there. Now remember, the retained earnings are a key here. They're the linkage between the income statement and the balance sheet. Remember, every year we take that year's net income, subtract a dividend if we're going to pay a dividend, and the balance is transferred into retained earnings. In other words, retained earnings represent all of the earnings that haven't been distributed to the shareholders by way of a dividend. So anything that affects the income statement, by definition, will affect retained earnings. Okay, notice there's why it's called a balance sheet. Total assets, 420 million. Liabilities and equity, 420 million. Okay, in other words, assets equal liabilities plus equity, the balance sheet equation that we saw in our earlier reading. So let's start a little bit with our assets. Asset recognition. Now, we've talked about this again in a previous reading. Here's our IFRS and US GAAP definitions. Probable future flow of economic benefit to the entity. Quick test. Is that IFRS or US GAAP? US GAAP. Why? The phrase probable in there. And remember, IFRS mentioned it being a resource from which an economic benefit would flow. It needs to be measurable with reliability. In other words, we need to put a reliable monetary value on it. So let's just run through a few account balances we have. Cash being the money we hold in our bank accounts. Cash equivalents, maybe a little bit trickier, tend to be short-term liquid investments, typically with a maturity of less than 90 days. So very short-term money market instruments, for example, would be included as equivalents. Inventories, well, we're going to talk about raw materials, finished goods and work in progress later, and we're also going to talk as well about how you value those. Trade and other receivables, these are the amounts where we've sold goods on credit, but our customer has not yet paid us at the year end. Remember, the sale and the accounts receivable are recorded when the transaction is entered into, not when the cash is paid or received. So our accounts receivables, or otherwise known as trade receivables, represent the amounts our customers owe us at the year end. Remember, we do deduct that bad debt provision, but we'll talk about that a little later. Prepaid expenses is when we've used a good or service, is when we've paid for a good or service, but not yet used it at the balance sheet. Because we haven't used the good or service, that means it shouldn't be in the income statement. So where does it go? It goes in as an asset, indicating that we have the right to use that good or service in the future. Certain financial assets are going to be included as well, and we'll talk more about those in particular, such as trading securities, available for sale securities, and also held to maturity. Deferred tax assets. Now, we've got a big reading on deferred tax a little later. Deferred tax being one of those areas that turns your hair grey overnight in the level 1 syllabus. What is a deferred tax asset? Put very briefly here, it's something, and we'll look at why later on, as I said, but when a deferred tax asset reverses, it results in you paying less tax. Because you're going to pay less tax in the future, it's going to meet the criteria of an asset because it's going to reduce economic outflows. Okay. Property, plant and equipment, PP&E, as we often call it, otherwise known as our tangible fixed assets. You can touch them, you can fondle them, you can stroke them. Might go to jail, but you can do it. Investment property that we see under IFRS but not US GAAP, typically being often, as it says, property, real estate, held for its investment potential. capital gains and income, for example. Intangible assets, assets that do not have any physical form, so you can't touch, fondle and feel them. Equity accounted investments, well, that's something to do with joint ventures and associates. Now, associates are companies where we have an influence but not outright control, and we're going to look at the detailed accounting of this at level 2. So equity accounted investments represents associates and joint ventures. Note that the US phrase that you sometimes hear for associate is affiliate, meaning exactly the same thing. Natural resources, where we've gone out and bought natural resources like oil fields, etc. And assets held for sale. Well, when we look at our PP&E, our investment property, our intangibles, we refer to these as assets held for use. We're going to continue to use these in order to run our business. Assets held for sale, however, are assets that were held for use where we've made the decision that we are going to dispose of them in the future. So at that point, they come out of assets held for use and go into assets held for sale, and we stop depreciating them at that point. Let's have a look at our liabilities. Remember, we defined liabilities as amounts owed to third parties rather than the shareholders. So a liability recognition is going to be a probable sacrifice of future economic benefits, i.e. cash flows leaving the company. Notice our second bullet point says, amounts received but not reported as revenue in the income statement, deferred or unearned revenue. Well, let's define that a little bit clearer for you. Let's imagine that a customer has paid you, but you've not yet completed the earnings activity, so you can't record a sale in the income statement. Where does that balance go? Well, it goes in as a liability, indicating that you still have earning activities to complete before you can record the sale. So it's when customers pay you in advance of revenue recognition. And our final point says, amounts reported as expenses which have not been paid. Amounts reported as expenses that have not been paid, typically we're going to refer to these as accruals. Okay, now all of you will have an accrual. Typically you have an accrual each month for your telephone. You've made calls on it, but you've not yet received an invoice. Therefore you have to estimate the cost and include it in this year's income statement and record a liability. So let's have a look at some of our classic items, therefore, that we're likely to expect to see in liabilities. Bank borrowings, i.e. overdrawn bank accounts and loans. Notes payable. These are just short-term interest-bearing debt, i.e. interest-bearing debt with a maturity of less than 12 months. Traditionally, these were often linked to your accounts or were linked to amounts that you owed your suppliers, and essentially you went back to your supplier and said, look, I can't pay you right now, I'd like to extend my credit terms, and they'd say yes, but we're going to start charging you interest, and rather than treating it as an account payable, it got treated as notes payable. But anyway, short-term debt instruments is all you need to know for the exam. Provision, it's an estimate of a future cost. Now, the accounting standards refer to prudence. It says as soon as you can foresee an expense, it has to be accounted for. So let's say we're going to do some restructuring next year, and I'm going to incur a load of redundancy costs. I would have to provide for it in this year's income statement when I make the decision. In other words, it goes through now. The other side would be a liability in my balance sheet. Now, when I come to actually make those people redundant, I pay out the cash and eliminate the liability. So a provision is an estimated future expense. So there's always going to be uncertainty around its true monetary value. Unearned revenues, we've described this already, where the customer has essentially paid you, but you've not met the revenue recognition criteria. Accounts payable, or trade payables as they're often known as, where essentially you've bought goods and services from a supplier on credit but not paid them at the year end. Other financial liabilities, well, what classic financial liabilities are we going to see in our accounts? We're going to see bank loans, we're going to see bonds that the company has issued, and we might even see leases as well, in particular finance leases that we'll discuss in a later reading. Accrued liabilities, that's back to our accruals. You've incurred a cost because you've used a good or service, but you've not yet received the invoice. Because you've used the good or service, that expense must be sitting in your income statement. So therefore, we need to create an expense in the income statement and create a liability in the balance sheet. Remember, because we haven't received an invoice from the supplier of this good or service, it wouldn't be in our financial journals, and as a result, it wouldn't be in our trial balance. So it's going to be a year-end adjustment to deal for accrued expenses. Deferred tax liabilities, again, we are going to encounter them later on. For whatever reason, which will become clear later on, you've entered a transaction that will result in you paying paying more tax, I should say, in the future. Because you're going to pay more tax in the future, essentially you're paying less tax now, but you're paying more in the future. Because of that, it's going to lead to an outflow, and because it's leading to an outflow of benefit, it meets the criteria of a liability. Okay, last one we need to describe here is our equity. Remember, we referred to equity as a residual earlier on. In other words, take the assets, everything the company owns, everything the company is owed, subtract the liabilities, everything the company owes to third parties, and you're left with stockholders' equity. In other words, assets minus liabilities, known as either net assets or net worth, equals stockholders' equity, known as, of course, the carrying value of the company when you look at financial ratios in equity. Capital characteristics, equity is permanent. Yeah, it typically doesn't have a redemption date on it. Now, of course, I know that's not necessarily the case with certain preferred shares, preference shares or preferred stock as we like to call it, which could be redeemable, but that's unusual. No mandatory charge against the earnings. Again, your common stock, it's permanent and it doesn't have a mandatory charge against earnings. In other words, you're not entitled to a dividend. The dividend, if you like, is at the choice of the directors in terms of whether to pay one and also the size of it. What do the shareholders have up their sleeve if they don't like the dividend decisions being made by the board of directors? Well, ultimately, if enough shareholders dislike it, we could remove the directors in a meeting, a special meeting, and vote them out. Legal subordination to creditors, well, this is simply saying in a liquidation, it's the shareholders that get their cash back essentially last. So we pay off all of the liabilities, then the preferred stock, and then finally the common stock, providing there are sufficient assets to do so. Skip 2 slides there. Right, okay, describe the uses and limitations of balance sheet analysis. Well, the uses, we're going to look at liquidity. Liquidity, can we pay off liabilities as they fall due? And of course, classic liquidity ratios are the current ratio and the quick ratio. We're going to look at how solvent we are. Solvency tends to take a slightly more long-term view, and it's looking at things like debt to equity ratios and ability to make distributions to shareholders. So we'll look at things like dividend coverage ratios there. Limitations. Well, limitations of the balance sheet, of course, is how are the items actually recorded in the financial statements. We've got a real mix here of historic cost, being essentially purchase price, amortized cost. Now, what is amortized cost? We typically see it with certain debt instruments when we issue bonds or when we buy bonds and they're treated as held to maturity. The amortization refers to the discount or the premium. Now, let's say you've issued a bond and you've issued it below par value. So initially, it sits in your balance sheet below its par value, what you issued it for, and then slowly we're going to amortize that discount, which will increase the value of the liability so that at maturity, the bond is sitting at par in the balance sheet. And it's exactly the same treatment when you buy bonds and you treat them as held to maturity. Again, if you're a little confused by that, don't worry. At this stage, we're going to look at bond accounting in a lot of detail in a subsequent reading. Fair value. Now, what is fair value? Often it's deemed to be the value an asset could be exchanged for or a liability settled at in an arm's length transaction with a third party. So you can think about it as market value, of course, or alternatively, if we can't establish the market value, then it might be value in use, which is often the present value of the future cash flows that the asset or liability is expected to generate throughout its life and disposal. Fair values may change after the balance sheet date. Indeed, they may. Fair value, because it's driven by market forces of supply and demand, is essentially changing all the time. So we're just simply seeing, when we look at the balance sheet, the fair value frozen on that balance sheet date. Off-balance sheet assets and liabilities certainly used to be a really significant issue. These days we're tightening up. The classic off-balance sheet, both asset and liability, that we're going to encounter in CFA Level 1 is going to be the operating lease. You lease in an asset to use under an operating lease. You've got a commitment to make future rental payments, but we don't see a liability, even though you've got the commitment to make payments, and we don't see the asset, even though you're using it within your business. It does not appear as an asset or liability, and operating leases, therefore, are a classic form of off-balance sheet finance. So let's have a look at our formats. It says describe alternative formats, our LOS. Report format, pretty rare, but essentially you have assets, liabilities, and stockholders' equity all in one single column. Account format that we saw a little bit earlier when we looked at our balance sheet, assets on the left, liabilities and equity on the right. And of course, not only did we have an account format, but we had a classified balance sheet as well, where we grouped the accounts into subcategories: current versus non-current, financial versus non-financial, of course, very common. Just be a little bit aware that we might find liquidity-based presentation rather than the distinction of current versus non-current. And as we've said in brackets here, this is common in financial institutions, where essentially they list out their assets from cash all the way down to the least liquid assets in terms of intangibles and deferred tax assets. Right, we're asked to distinguish now between current assets, long-lived assets, current liabilities, and long-term liabilities. So let's start off with our definition of a current asset. So a current asset includes cash and other assets that will be converted into cash or used up within 1 year or one operating cycle, whichever is greater. Now, typically, 1 year is going to be greater than one operating cycle. The operating cycle is the length of time between receiving raw materials, starting the production process, finishing the production process, and selling the goods. In total, we call that days of inventory on hand, and we'll see that ratio defined a little later. And then, plus the time between selling the finished goods and collecting the cash from your customers. We're going to refer to that ratio as the days of sales outstanding. In other words, the total time between receiving raw materials and collecting cash from your customers from selling the finished good is known as the operating cycle. Okay, we're going to see this again in ratio analysis in a little bit more detail a little later. Current assets are presented in order of liquidity. So essentially you see the most liquid first, and as you go down the list, the least liquid. Well, that's what you see under US GAAP. Interestingly enough, under IFRS, it's reverse liquidity order. Current assets reveal information about the operating activities and capacity of the firm. Yeah, current assets are a component of working capital, and therefore we can start to look at efficiency ratios here. How efficiently the firm uses its current assets to generate sales, the level of inventory it has on hand, the level of accounts receivable, how quickly it collects its accounts receivable, etc. So a lot of efficiency related ratios are linked to your current assets. So here's our list of current assets, and we've talked about a lot of these before. It says not only to describe the current asset, but the LOS asks us to be aware of the measurement basis. In other words, what is the figure in the balance sheet? Is it cost? Is it amortized cost? Is it fair value? So let's start quickly with cash and cash equivalents. Cash is money in the bank account, and cash equivalents, of course, are short-term investments, highly liquid, maturities of less than 90 days. Essentially, they're going to either be amortized cost or fair value. Quite frankly, there's unlikely to be a difference between the two. Marketable securities. Now, marketable securities, we're going to see three major classifications here. We're going to see held to maturity, we're going to see trading securities, and we're going to see I can't remember which ones I've done now. Held to maturity, available for sale, and fair value through profit or loss, otherwise known as trading securities. Okay, hopefully that's got all three. Okay, now notice it says amortized cost. This only relates to held to maturity securities. Held to maturity are debt instruments where you have the intention and ability to hold to maturity. And remember, amortized cost means cost essentially plus amortized discount or minus amortized premium. The idea, remember, is in this case, the investment value will migrate towards par value over the life of the investment. Fair value is used for trading securities and available for sale securities. Essentially, we're doing a mark-to-market process, and we're just using the most recent fair value. In other words, the market price on the closing balance sheet date. Accounts receivable or trade receivables, net realizable value. So they're in there at what we believe we'll receive from the customer, of course, minus that bad and doubtful debt provision. Remember, if you know or if you suspect that the customer is not going to pay, and of course that will be based on your past experience, you have to reduce your accounts receivable. Remember, the definition of an asset is a future economic inflow of benefit. If the customer doesn't pay, there is no inflow of benefit. Here are inventories. Raw materials, work in progress, finished goods. Raw materials, of course, are components that you're going to use in the manufacturing process. Finished goods are the finished items awaiting sale. And work in progress is where you've started to manufacture a good, but not yet completed at the year end. Manufacturing, we're going to look at standardized costs. So in other words, if you manufacture goods, it's not the actual cost of producing your good that we're going to include, but it's the normal standardized cost. What is the normal cost of producing? Now, if we're looking at trading companies that buy and sell goods rather than manufacture, then we're going to look at cost flow methodology to value their ending inventory, and we're going to come across three methods: FIFO, AVCO, and LIFO. FIFO, AVCO are allowed under both US GAAP and IFRS. You should be aware that LIFO is only allowed under US GAAP, prohibited under IFRS. Now, FIFO says you sell the oldest items first, so your ending inventory is made up of the most recent purchases, so we use recent purchases to value it. LIFO says you sold the most recent items first, so ending inventory is made up of the oldest purchases, so we use the oldest purchases to value it. And AVCO, you say, I've got no idea what I've sold, and therefore you value your ending inventory at the average price paid during the year, average purchase price. Prepaid expenses, remember you've paid for a good or service but not yet used it, so it doesn't go through the income statement. Instead, it sits there as an asset indicating you're entitled to use, and that's going to be at historic cost. Deferred tax assets, you've paid more tax now, and as a result you'll pay less tax in the future, and they're going to sit there at the amount of tax you're going to save less a valuation allowance potentially. Now, what is a valuation allowance? Let's think about this. To benefit from a deferred tax asset, remember, when it reverses you will pay less tax. So in other words, when it reverses you need to be profitable, because if you weren't profitable you're not going to be paying tax in the first place. So if we suspect that the company has insufficient profits to benefit from its deferred tax assets, it's not going to be saving itself tax, and as a result having bigger cash flows in the future, and therefore their deferred tax asset wouldn't fully meet the criteria of an asset, so we reduce it by the valuation allowance, essentially the amount of the asset that we're going to lose because of insufficient future profits. Now, inventory as well, we should mention, is held at the lower of cost and net realizable value. Well, it is under IFRS. Under US GAAP, notice it's the lower of cost and market value. Now, cost, as we mentioned earlier, is the standard cost of producing your goods and services. Notice it's all of the costs of bringing your inventory to its current location and finished condition. Any costs incurred after the inventory is finished are irrelevant. So it's going to exclude any abnormal production costs, such as material wastage, any storage costs for your finished goods, any admin overheads, and any selling costs. It's only the cost of getting that inventory into its finished condition. So it's going to be at the lower of cost and net realizable value. What is net realizable value? Well, let's just think about finished goods for a second, because then we can ignore that second line, estimated cost of completion. Net realizable value for a finished good is the estimated selling price minus any estimated selling costs, i.e. what you think you're going to be able to sell it at, less any costs of completing the sale. So what we're saying is the IFRS says hold your inventory at the lower of cost, but if net realizable value has declined below cost, then essentially net realizable value would now represent the future inflow of benefits, so we would have to reduce the asset's value. It's called a write-down of inventory, essentially. Now, US GAAP is going to be a little bit trickier. It's going to be the law of cost and market value, and we're going to talk about that in more detail in a future reading. So we'll come back to these ideas on this slide. Non-current assets. These are essentially our infrastructure which we use to run the business. So these are assets held for continuing use within the business, not resale. Now let's just be a little bit careful here. It doesn't mean that we can't dispose of these assets. All it really means is the intention was that we were going to use them to run our business rather than dispose of them. So it doesn't mean you can't dispose, it just means that wasn't the purpose when you purchased the asset. So notice these are assets that are not consumed or disposed of in the current period, and therefore it's the infrastructure from which the company operates. It's buildings, it's machinery, it's cars, it's fixtures and fittings, that kind of stuff. Yes, of course, we're going to get information on the firm's investing activities. When we talk about investing activities, we're talking about the cash that the company spends on its PP&E, its intangibles, and equity and debt in other group companies, such as subsidiaries, associates, and joint ventures. Right, let's have a look at our accounting for long-term assets. So long-term assets convey benefits over time. This is the idea of capitalization, and it's using the accruals process. What we're going to do is store the cost into the balance sheet and then release that cost out of our balance sheet over time to match against revenues as the asset generates revenues. Remember what we talked about when we talked about accruals. We talked about the matching concept that says match costs against the revenues. So any cost you incur that will result in future higher earnings, in other words, it improves earnings, then we're forced to capitalize, store it in the balance sheet, and then release the cost to match against those higher future revenues. And of course, the mechanism that we tend to use to release the cost from the balance sheet to the income statement is depreciation for our tangible assets, and it's amortization for our intangibles. So let's have a look at some classifications. Tangible assets, so these are our land, buildings, equipment, and natural resources, so plant, property, and equipment, or property, plant, and equipment, and natural resources. Intangible assets, remember, these have no physical form, and we'll talk more in detail later on. Things like copyrights, patents, agreements, goodwill is the classic one, arising on acquisition of subsidiaries. Investment property we only see under IFRS, it's not under US GAAP. And these are essentially assets held for their income and capital appreciation potential. The classic one in there is real estate, essentially. That is, we're not going to use it for running our business. Essentially, we're renting it out. We're holding it as an investment, essentially. Now, notice our plant, property, and equipment is recorded at purchase cost, including shipping, installation, or construction cost, including labor, materials, overheads, and interest. In other words, we're allowed to include all of the costs of getting that PP&E into its location, into working condition. Once it's up and running, then any additional costs typically have to be expensed unless we can prove that they've increased the earnings potential of the asset. Let's talk about depreciation and depletion briefly. We've talked about it already, really. Tangible assets, remember, they're going to increase the earnings potential of the company, and in that situation we have to apply the matching concept. Because they're increasing earnings over future periods, we have to match their cost against those earnings. So we store the cost in the balance sheet, known as capitalization, and then release it through the income statement via depreciation, if we're talking about tangible assets. The exception is land. We do not depreciate land. Why do we not depreciate land? Well, depreciation is all about spreading the cost of the asset over its life. And of course, the life of a piece of land is the life of the planet Earth. It's almost infinite, so therefore it's not worth depreciating. All other assets are, including buildings. So tangible assets, of course, are going to be depreciated. Intangibles are going to be amortized, which is just really depreciation, but what we call it for an intangible. And natural resources, as they're used up over time, we use a method called depletion. Essentially, as you extract a natural resource, if it's an oil field or a gas field, or as you cut down timber in a wood, you deplete that natural resource. And of course, the other side is you convert it into inventory for sale. So depletion is the method to allocate the cost per unit of a natural resource as we convert it into inventory. Now, balance sheet values are going to be historic cost. Remember, that's purchase price plus all of the costs of getting the asset into location and working condition, less accumulated depreciation. Accumulated depreciation is nothing more than a running total of the depreciation that's gone through the income statement so far. Okay. Now, depletion, of course, that refers to our natural resources. So our natural resources are going to be historic cost less depletion. And, of course, our intangibles are going to be historic cost minus amortization. It says unless the values are impaired under US GAAP and IFRS. Well, again, we're going to see impairment in the later reading, so a very brief intro to it right now. Impairment is all about carrying value of the asset. When we say carrying value of the asset, we simply mean the value that's recorded in the balance sheet. Now, if the fair value of the asset, or the value in use, which is essentially present value of the future cash flows expected from the asset's use, drops below essentially its carrying value, you have an impairment under both US GAAP and IFRS. How they're measured under the two is slightly different, and as I said, we'll cover it in a later reading. Okay, fair value less any accumulated depreciation under IFRS. Remember, under IFRS, you can revalue both PP&E and intangibles to their fair value. You can. You don't have to, but if you do, then you're going to have to do it consistently year on year. You can't pick and choose, essentially. And if you choose fair value, you can choose which asset types to apply it to, which asset long-lived asset classes. So, for example, you might choose to revalue your revalue your buildings, but not any of your other tangible assets. Okay, lovely. Intangibles. Right, move into our intangibles. We're going to use them for continuing use within the business, but you can't touch, feel, and fondle them. They have no physical form. Two types, identifiable and unidentifiable. Identifiable, you can purchase them separately. They could be acquired singly. In other words, things like a royalty agreement for music. You could go out and buy that royalty agreement, and then you'd be entitled to future royalties. Now, typically, of course, that agreement would have a finite life, so the identifiable intangible would be recorded at cost, what you paid for it, and that would then be amortized over its useful economic life. Excuse me. Unidentifiable intangibles you cannot separately purchase. Now, the classic example of this is going to be goodwill. Goodwill, of course, arises when we acquire subsidiaries. It's the difference, essentially, between the price that we pay and the value of the net assets that we've acquired. That's actually known as partial goodwill. There's also another measure, full goodwill. We'll leave that till the level 2 syllabus. So in other words, the difference between what you pay for a company and the value of its net assets adjusted to fair market values is goodwill. Now, of course, the accountants say it's what you're paying for everything that isn't in that company's balance sheet. It's relationships with suppliers, it's relationships with customers, the relationships with employees, brand names that aren't capitalized, internally generated brand names, and all of that kind of stuff. Of course, if you're a bit of a cynical analyst, you might argue that goodwill simply arises because companies pay too much for the companies they acquire. Now, key point is you can't buy the goodwill of a company separate from all of the other assets and liabilities. So it cannot be acquired singly. It's not amortized anymore because, again, it doesn't necessarily have a finite life. The idea is it can be sustained forever. Some people agree with this, some people don't, but that's the way the rules now say. But it must be subject to an annual impairment review. Again, impairment reviews we're going to cover a little bit later. And in fact, you'll see the impairment review for goodwill in the level 2 syllabus. So, intangibles may only be recognised, in other words, recorded in the balance sheet, if they can be measured reliably. What this essentially means is we can only include purchased intangible assets in most cases, i.e. when we've gone and bought them at an arm's length transaction, because we can put a dollar or a monetary value on them. What that often means, therefore, is internally generated intangibles we cannot include. Let's try and imagine a company wants to capitalise its own brand name and store it in the balance sheet. Well, if you've gone out and purchased that brand name, then we can put a monetary value on it, i.e. the price you paid for it in that arm's length transaction. If you've internally generated it via marketing over the years, problem is, what is the monetary value of that brand name? Now, companies in the past have actually attempted to include their own internally generated brand names as intangible assets, and the accounting standards authorities have immediately made them remove them again. So in other words, look, it's too much subjectivity about the monetary value. You can't do it. So our typical intangibles are going to be patents and copyrights, brand names and trademarks. Notice purchase patents and copyrights, purchase brand names and trademarks, purchase franchise and license costs, direct response advertising. So here's some internally generated intangible that can be capitalized. Now, direct response advertising is a little bit of a tricky one. It's a bit of an oddity. Not all advertising. It's advertising that you can prove directly relates to increased sales. It's things like cold calling, for example, phoning up customers and trying to get them to buy. If you can prove there's been a direct link between this form of advertising and higher sales in the past, and you can prove that the market has not substantially changed, then you may capitalize and amortize. Goodwill, of course, arises on the acquisition of subsidiaries, as we mentioned earlier. It also arises when you acquire joint ventures and associates as well. But under equity accounting, you don't see it as a separate intangible asset. And computer software development costs. Again, this is a bit of an oddity. Typically, the rule here says any costs incurred in establishing its technical feasibility are expensed, but once feasibility has been established, any additional costs can be capitalized. So what is going to be expensed? Internally generated brand names, mastheads. What are mastheads? Kind of company logos and newspaper logos is why they get called mastheads. Publishing titles, customer lists. Anything internally generated, too subjective to put a monetary value on it. Startup costs and training costs. Now again, you might say, well, hang on a second, training costs. I train my employees, that improves their earnings potential. Surely I should be able to capitalize it and amortize over their remaining working life. Well, problem is, how do you put a monetary value on the added value that you've created from training? Administrative and general overheads, well, these are to do with the day-to-day running of the company, and therefore they have to go through the income statement. They don't lead to higher future earnings. My wages are a good example of that. Kaplan paying my wages does not lead to higher future earnings. Why? Because if they stop paying me my earnings, my wages, I wouldn't turn up. They're paying me for past service, essentially, not future service. Advertising and promotion typically has to be expensed, remember, with the exception of that direct response advertising. Relocation and reorganization costs, again, hard to prove that they lead to higher future earnings. Redundancy and termination costs, again, how does it lead to higher future earnings? And R&D, now this one's a little bit of a tricky one again. Research and development under US GAAP is always expensed. Both research in terms of pure research and development in terms of developing a product. Notice under IFRS, development of an expenditure may be capitalized. Research is still going to be expensed through the income statement, but development may be capitalized if it meets certain criteria that are all looking at its future earnings potential. They're looking at the product. Have you established a market? Can you complete the product? Is it feasible to complete the product? Do you have the resources? Have you established there are customers, etc.? Okay, now again, you don't need to know the criteria for capitalization of development expenditure under IFRS. Here's our goodwill. Again, just to give us a flavor of goodwill. Not too excited about it at level 1. Again, we're not going to do group accounting until we hit the level 2 syllabus. So here is our goodwill. This is actually known as partial goodwill that we're seeing here, and it's the difference between the price paid to acquire the other company's shares, less the fair market value, i.e., the balance sheet assets and liabilities adjusted to their fair market values. Subjectivity there, of course, of the net assets acquired. Okay, now again, of course, if you didn't acquire 100% of the company, you'd take in 80% of the fair market value of its net assets if you acquired 80% of the shares. Now, the difference between acquisition price, what you paid, and the share of the net assets you've acquired is goodwill. It's deemed to be an intangible asset, and as we said, it no longer gets amortized, but it is subject to annual impairment reviews. Lots of analysts simply believe it's because you paid too much to acquire the company, in which case it won't lead to higher future earnings, and therefore they remove it as an asset. Remember, definition of an asset leads to future economic benefit inflows. So here's goodwill analysis. Impairment indicates that goodwill often results from overpayment. In other words, lots of companies that have goodwill also have impairments of goodwill, indicating that essentially that it results from overpayment rather than it is a genuine productive asset that leads to higher future earnings. As a result, lots of analysts like to remove goodwill. So they take goodwill out of the balance sheet assets. Again, you'd have to adjust stockholders' equity as well, otherwise the balance sheet wouldn't balance. They remove any goodwill impairments from the income statement. In other words, totally eliminate goodwill out of the accounts. Now, when we evaluate business acquisitions, we should consider what we paid for it, the assets we acquire, and its future earnings prospects. Right, let's have a look at some financial assets and liabilities. Stocks, of course, refers to equity, shares. Bonds, of course, are really IOU instruments where they're debt instruments, of course. Receivables are typically amounts that are owed to us by our customers. Notes receivable, short-term interest-bearing debt. Notes payable, short-term interest-bearing debt that the company has issued. Loans, bank loans, of course, that we've taken out with banks, and derivatives, of course, being futures, forwards, options, and swaps. So let's turn our attention to financial assets. We've talked briefly about these classifications before. With financial assets that are held purely for their passive investment potential, i.e. they're not subsidiaries, they're not associates or joint ventures, then we have three major classifications. Trading securities, these are purely speculatively held assets. You're likely to find these when you look in the accounts of big investment companies. So if you look at the accounts of an investment bank, you're going to see trading securities. Available for sale securities. Definition of these are securities that may be disposed of for liquidity purposes. Both trading and available for sale securities are going to be held at their fair value. Okay, so in other words, they're not recorded at historic cost, purchase price, they're recorded at fair value, their current market value. Now, derivatives, again, will be recorded at fair value, whether that is a naked derivative, i.e. standalone, pure for speculative purposes, or whether it's embedded in a non-derivative instrument, such as a bond with an equity call feature, a callable convertible bond. Notice as well, assets with fair value exposures hedged by derivatives will also be recorded at fair value. It makes sense. If you're recording the derivative at fair value, well, it's the gains and losses in the derivative should offset the gains and losses on the asset, of course. So therefore, both need to be recorded at fair value. Financial liabilities, again, could be derivatives, and again, any liabilities where we're hedging their fair value using derivatives, again, should be reported at fair value. Again, remember, the gain or loss on the liability here should be offset by the gain or loss on the asset. Cost or amortized cost. Now, remember, when we talk about cost, we're typically talking about purchase price and any costs involved in getting the asset into location and working condition. So for financial assets, it's unlisted instruments under US GAAP. So fine, unlisted debt and equity. Held to maturity investments. Now these are actually at amortized cost. If you have held to maturity investments, essentially, then originally they're recorded at purchase price, but we then amortize any premium or discount. This has the effect of changing the asset's value to par value over its life. So if you bought a bond at a discount, it will slowly migrate to par over its life. If you bought a bond at a premium, then it's going to slowly come down to par value over its life. Again, we're going to look at a lot of treatment on this in the Level 2 syllabus, but we'll see a little bit at Level 1. Held to maturity only applies to debt instruments where you have the intent and the ability to hold it to maturity. Bank loans are typically reported at costs, and receivables, i.e. amounts owed by our customers, of course, are going to be at cost, what they owe us, net, of course, of any bad or doubtful debt provision. Financial liabilities, again, are typically at amortized cost. Let's take that view, the view of bonds again. Remember, it's just the same as the unlisted, it's just the same as the held to maturity investments. If you issue bonds, if you issue at a discount, initially it sits there below par and then will increase to par over the bond's life. If you issue the bond at a premium, then it's going to decrease to par over the bond's life. Right, so a little bit of our marketable securities in a tiny bit more detail that we need to be aware of here. Our three classifications and then an example. So here's our held to maturity. Remember, by definition, because it's got that phrase maturity in there, it only applies to debt securities. And again, the key is you have to have both the intention and ability to hold to maturity. If you dispose of held to maturity prior to maturity, then there are penalties. You're deemed to have tainted and you can't use that classification anymore. So the securities are going to be held at cost, it says here. Again, let's be a little bit more specific than that. It's actually going to be amortized cost, the amortization of that premium or discount. And if you're worried about amortization of premiums and discounts, don't be, because we're going to recover it in a later reading when we look at issuing bonds. So securities are held at amortized cost. In the income statement, we're going to have income and realized gains or losses. What is the income going to be? Now, actually, it's a little bit complicated here because it's not simply the coupon received. If the bond was issued at a discount, it's going to be the coupon plus the amortization of the discount. If it was issued at a premium, it's going to be, or it was purchased at a premium, I should say, rather than issued. If it was purchased at a premium, then it's going to be the coupon minus the amortization of the premium. Realized gains and losses are any gains and losses that we make on disposal. Now be careful here. Held to maturity should not be disposed of prior to maturity. Doesn't mean it can't, but remember there are penalties if you do so. So typically if we do hold to maturity, the balance sheet value will be par at maturity. It will then redeem and will receive par, so there's no gain or loss through the income statement if we do indeed hold to maturity. Available for sale, as said earlier, is securities, both debt and equity, that may be sold for liquidity purposes. Could be a current asset or a non-current. Key point is we're going to record in the balance sheet at its fair value, i.e. its market value. Now, of course, if you're changing the balance sheet value of the asset as market value fluctuates, something else in the balance sheet is going to have to change, otherwise the balance sheet won't balance. In fact, we take the unrealized gain or loss each period and we take it directly into our stockholders' equity. In the income statement, again, it's going to be exactly the same as the held to maturity method. Okay, so in other words, if it's equity, you're going to see dividends and realized gains and losses on disposal of the equity. If it's debt, you're going to see coupon plus amortized discount or minus amortized premium plus any gains or losses on disposal. Now, trading securities are essentially the accounting treatment is exactly the same as available for sale. The only difference is where does the unrealized gain or loss go to? Under available for sale, we took it directly into stockholders' equity. It's one of our comprehensive income items. Under, of course, trading securities, we're going to take it through to the income statement. Now, you might say, if we take it to the income statement, how does the balance sheet balance? Because we've increased assets. If, let's assume market value's increased, we would have increased assets. Well, of course, it will still increase because the unrealized gain would hit the income statement, increasing net income, increasing retained earnings, which of course increase stockholders' equity. Okay, so key point, unrealized gains and losses this time are going through the income statement. So let's have a little look at some numbers just to bring this all to life, hopefully. So we've got Ellerslie here purchasing 35% annual pay, $1,000 face value bonds. So notice the price is par value. In other words, we're not going to have any amortization of premiums or discounts here. Why? Well, simply because we're dealing with level 1 at this stage. Look, we'll see amortization of premiums and discounts when we issue bonds later. We'll deal with amortization of premiums and discounts when we hold bonds as investments in the level 2 syllabus. So we will see it, just not yet. Okay, so 35% annual pay $1,000 face value bonds at par. The market price of the bonds on 31st of December X4 was $1,010. Of course, that's the year end. So we've got a $10 unrealized gain on each bond, and we've got 30 bonds. Now, of course, the interest on the bonds, that's going to be dead straightforward. That's going to go through our income statement. 30 bonds, 5% coupon, par value $1,000, so that's $1,500. And, of course, that goes through the income statement. Okay, so we're asked, what is the balance sheet and income statement if we treat as held to maturity, available for sale, and trading? So let's start this off by looking at the interest received. Now, the interest received is going to be the same under all three methods. It's simply going to be the coupon that you received. Remember, there is no premium or discount here because we bought them at par. Even if there was a premium or discount to be amortized, we still report the same income under all three methods: trading, available for sale, and held to maturity. Now, the treatment of the unrealized gains and losses. Now, we've got an unrealized gain because we bought at $1,000, and at the end of the year, we've got $1,010. So we've got a $300 unrealized gain. Now, of course, that's added to the purchase price. So now, essentially, we're showing an investment of $30,300 rather than just $30,000 when we purchased them. But where does that other side of that $300 go? Remember, if it's a trading security, it goes through the income statement. And if it goes through the income statement, you've got higher net income. And if you've got a higher net income, you've got higher retained earnings. If you've got higher retained earnings, you've got higher stockholders' equity. So stockholders' equity via the retained earnings will be higher by $300. Available for sale. In terms of the balance sheet asset, the same as the trading securities. In other words, we'll now show the balance sheet asset at $30,300. So we've got a $300 unrealized gain. The big difference is where it goes. It does not go via the income statement. Instead, we're going directly into stockholders' equity. It's treated as one of these comprehensive income items. And finally, held to maturity. Well, remember, under held to maturity, the investment is reported at amortized cost. Now, of course, we don't have any premium or discount amortized here, so it will just sit at $1,000 over its life. Remember, if you buy bonds at a discount, they'll increase to par over life. Buy them at a premium, they'll decrease to par over their life. Realized gains and losses due to changes in market value are not reported under the held to maturity classification. Of course, as we know, equity securities cannot be classified as held to maturity because they are essentially perpetual. It's only debt that really has maturity dates. Right, summary really here. Dividends, interest, realized gains and losses always go through the income statement. The interest will be the same under all three methods, even if we have the amortization of premiums and discounts. In other words, unless the bond was bought at par, interest is coupon minus any amortized premiums or plus any amortized discounts. Unrealized gains and losses only go through the income statement for trading securities. Be a little bit aware that you may see the phrase fair value through profit or loss. That's simply the IFRS name for trading securities. Unrealized gains and losses go through the balance sheet for both trading and available for sale securities. Of course, we know that they're reflected in assets at their market value, but the unrealized gain or loss on available for sale does not hit the income statement. Instead, it goes direct to stockholders' equity as one of our comprehensive income statement items. Right, turning our attention at last to current liabilities as we make some progress here. Current liabilities satisfies any of the four criteria. So, to be settled in the entity's normal operating cycle, remember the difference, the time taken between receiving raw materials and collecting cash from selling finished goods. so days of inventory on hand plus days of sales outstanding, held for the primary purpose of being traded, is due to be settled within 12 months from the balance sheet date. That's what I tend to think of it as. Look, we're going to pay these off within 12 months. And of course that means the company cannot delay or defer payment for more than 12 months. Doesn't meet this criteria, it's deemed to be non-current. Right, let's have a look at a few of our classic current liability names. Accounts payable or trade payables. And of course, this is where we bought goods from our suppliers or services from our suppliers, but not yet paid them at year end. Notes payable. This is typically where we've got some accounts payable. We've gone to our supplier and said, can we extend our credit terms? And they've said, fine, but we're going to start charging you interest. That's typically a notes payable. So it's just a short-term interest-bearing debt instrument, as simple as that. Current portion of long-term debt is any long-term finance that is now falling due for payment within 1 year. So, for example, you may have issued a 10-year bond. 9 years have now passed, so it was sitting in long-term liabilities for 9 years. In its final year, it gets transferred into current liabilities. Accrued liabilities. Remember, you've used a good or service, but not yet received an invoice for it. Because you've used the good or service, you have to estimate the cost, put that in your income statement, and record a liability in current liabilities within your balance sheet. And the final one, unearned revenue, where essentially a customer has paid you, but you've not yet met the revenue recognition criteria. So it can't go in as a sale, so instead it goes in as a liability. Once the revenue recognition criteria are finally satisfied, we eliminate the liability and report it as a sale in our income statement. Components of equity, describe, says our LOS, describe the components. So first of all, we have contributed capital by owners. Okay, so this is the common stock at par value. And we're going to show the issued, so what the company has actually issued out there at par value, and authorised, which is the total amount of shares that the company can issue without needing to increase its authorised share capital. Once you hit authorised share capital, once you issue equals authorised, in order to issue any future shares, the company would need to go back to its shareholders and get them to agree via a vote to increase the level of authorised share capital. Preferred stock, of course. Preferred stock that is irredeemable. If it is redeemable, i.e. has a fixed date, then it tends to get treated as a debt instrument because preferred stock has no votes. It has a fixed dividend, rather like a fixed coupon, as a percentage of par value. And of course, if it's redeemable, then it's got a fixed life as well. So redeemable preferred stock is nothing more than a debt instrument. Okay, legally it's equity, but it is a debt instrument in terms of all characteristics and how it behaves. So we only include preferred stock within stockholders' equity if it is irredeemable, i.e. it has an infinite life. Now I should actually mention as well, when we go back to that contributed capital by owners, we actually split out, and we can't see it on this slide, the par value of the stock issued and additional paid in capital, which is often known as a share premium account in Europe. So for example, imagine a company has a $1 par value and it issues a share for $3. Well, if it issues a share for $3, its cash goes up by $3, common stock goes up by $1, and additional paid in capital would go up by $2. So any amount over and above par at which the shares are issued goes into additional paid in capital, the share premium. Why do we care? Well, we don't really tell you at level 1 or in fact level 2, but there's more flexibility about what a company can do with its additional paid in capital in terms of doing things like scrip issues and stock splits. Treasury stock, as we mentioned earlier, this is when a company repurchases equity in itself, so it reduces stockholders' equity. Now, shares held as treasury stock when the company goes back and buys its shares, number one, often an indication that the company's shares are undervalued, because surely the company would only want to buy its shares if they believed they were undervalued, not overvalued. So it can be often seen as a positive signal to the market. But essentially they go in there as a negative balance reducing stockholders' equity. You should be aware that whilst the shares are held as treasury stock, they lose their voting potential and they lose their dividend potential, but they can be reissued at a future date. Of course, it makes sense that they lose their voting potential. It'd be crazy that the company could vote on matters relating to the company. Non-controlling minority interests. These relate to acquisitions of subsidiaries, potentially, when you've acquired less than 100% of the voting share capital. So if you've got 80% of the voting share capital, then there's a minority kicking around. Now, when we produce the group consolidated accounts, they're produced on the basis of control rather than ownership. So you bring in 100% of the assets of the subsidiary, 100% of the liabilities of the subsidiary, and add them to your balance sheet. Now, hang on a second. You only owned 80% of the share capital. So the non-controlling minority interest reflects the net assets that you've included that didn't belong to you, that belong to the minority shareholder. They're included in stockholders' equity under both IFRS and US GAAP. The US GAAP change is relatively recent. US GAAP in the past used to treat them as mezzanine finance, not quite debt, not quite equity, but it's moved in line with IFRS, and we now treat them as a component of stockholders' equity. Accumulated and other comprehensive income, well, these are going to be some strange items. We're going to see the unrealized gains and losses on available for sale securities. Okay, we talked about those earlier. We're also going to see some pension adjustments that we don't encounter until level 2, although we briefly mentioned pensions in the level 1 syllabus. We're going to see some foreign exchange gains and losses under something called the temporal method to do with converting overseas subsidiaries back to your reporting currency. Again, we don't need to worry about that until level 2. And we also see some unrealized gains and losses as a result of derivatives used for hedging purposes. Again, not until we get to the level 2 syllabus. I should point out as well that under IFRS you get an extra component of comprehensive income, and remember you can revalue your plant, property and equipment and intangibles, and if you do, any unrealized gains and losses on them goes into comprehensive income. The only other item we need to mention is our retained earnings, our 4th bullet point there. Remember, the retained earnings are the linkage between the income statement and the balance sheet. Each year you generate your income, net income, pay out a dividend or propose a dividend. Anything that's not paid out by way of a dividend is reinvested in the company and is added to retained earnings. And in fact, these retained earnings then can be used to pay out uncovered dividends in the future. Okay, we're asked to be able to analyze the statement of changes in stockholders' equity. And remember, look, basically it's simply a reconciliation of last year's stockholders' equity. So you can see in this particular slide, we're saying that last year's stockholder equity was 75,942, and to this year's balance sheet stockholders' equity, which we're saying is 75,120, and I should have worn my glasses, 128. Okay, and it's just splitting out why it's changed. So let's have a look at this particular company. Now notice you can see both issuance and repurchase of common stock. Notice the repurchase is bigger than the issuance in this particular case. We can see as well, when we look at retained earnings, that year's net income, 6,994, minus that year's dividend, 2,360. Remember, retained earnings goes up by net income and down by dividend proposed. And then you can see our comprehensive income items essentially here. So what have we got in our comprehensive income? You'll see the first item, the 40, is unrealized gain or loss, in this case, unrealized loss on available for sale securities. Then we've got unrealized loss on a cash flow hedge. Remember, derivatives held for hedging purposes. Again, you don't really need to know that until we get to level 2. Adjustments to pension liabilities. Again, we've got a 26 adjustment here. Again, you'll encounter that at level 2, so don't need to worry about it now. And also the cumulative translation adjustments caused by the or current rate method of converting overseas subsidiaries. Again, level 2 subject. So the only one you really need to understand in the level 1 syllabus is the unrealized loss, gain or loss on available for sale securities. Our next LOS says convert the balance sheet into common size statements. Now, with a common size income statement, we saw that every item in the income statement was shown as a percentage of total sales. Well, in the balance sheet, we're going to show every item in the balance sheet as a percentage of total assets. Why? Well, because, of course, typically the balance sheet sits there at monetary values, which are in absolute terms, and therefore it's very difficult to compare firms of differing sizes. By converting into a percentage of total assets for each line in the balance sheet, we then, of course, have a relative measure, and of course that aids comparisons over time. We can see how our company's percentage is changing. So how much is your inventory as a percentage of your total assets over time? And of course you can look at cross-sectional analysis, i.e. comparing different companies at the same point in time. Now again, remember with cross-sectional analysis we need to be careful that the accounts are prepared using consistent accounting policies. If not, you're going to have to convert one company's accounting policies in line with the other before computing. Our final LOS is calculates some classic liquidity and solvency ratios. Well, we see them here, but we also see them again in a subsequent reading purely on ratio analysis. So I'm going to go quick here and then slow down in that later reading. Really, I cannot stress how important it is to know your ratios well. You are just going to see tons of them. So, for example, the examiner may test, do you know the difference between inventory under FIFO and LIFO by the effect on the current ratio? Okay, so the current ratio, current assets divided by current liabilities, rule of thumb needs to be greater than 1. Essentially, if the liabilities are greater than the assets, how are you going to pay the liabilities when they fall due? Now, with that in mind, you've got to be a little bit careful because you can sustain current ratios that are less than 1, but only if you collect cash from your customers before you pay your suppliers. So in other words, you have a negative cash operating cycle. Again, don't worry, we'll come back to this later. Quick ratio just adjusts the current ratio for an illiquid current asset. And that illiquid current asset is inventory, not very liquid. First of all, you've got the raw materials. First of all, you have to produce the good, then you have to sell the good, then you have to wait for the customer to pay. So there's a long lag between having raw materials or inventory and cash. So we're just reassessing liquidity, ignoring the most illiquid of our current assets. Finally, the cash ratio, which looks at cash and marketable securities, so any listed securities that could be sold, over current liabilities. Solvency ratios, remember, are more to do with your capital structure, so debt to equity. So the first one is long-term debt to equity, where we look at total long-term debt over total equity. Now, total long-term debt is deemed to be all liabilities falling due after more than 12 months, over total equity, which is all of our stockholders' equity items. Okay, so in other words, the common stock, the preferred stock, the additional paid-in capital, the retained earnings, and the comprehensive income items. Now, let's have a look at our debt to equity. This is the most common one, total debt over total equity. You need to know the definition of total debt. It's all of your long-term liabilities plus any interest-bearing current liabilities. Okay, over total equity. Total debt over assets, again, total debt, remember, all long-term liabilities plus interest-bearing current liabilities over your total assets, and then financial leverage multiplier, which we're going to see in DuPont analysis later on, total assets over total equity. Again, basic idea with the financial leverage multiplier is that if the asset purchases were being financed from equity rather than issuing any debt, then the ratio would be close to 1. Once you start to finance asset purchases, whether that's long-lived assets or working capital, using debt, then assets are going to increase, equity will be unaffected, the ratio will start to increase beyond 1.